So most of you probably heard about buying down the rate or paying points to get a lower interest rate. But a lot of you may not have heard about the exact opposite, where you take a higher interest rate and you get a lender credit towards your closing costs. We call that premium pricing. So before I get into why premium pricing would make sense for a particular client, I first will explain that the mortgage company's profit margin is going to be the same regardless of the rate that you choose, and the loan officer's commission is going to be the same regardless of the rate that you choose. So if someone proposes this to you, if the loan officer proposes premium pricing, you don't have to worry or think that there's an ulterior motive there, that the loan officer is just looking out for their best interests. So ultimately, you're going to want to premium price and get a lender credit if you know for sure that you're going to refinance or sell the house in the next year. If you're going to refinance or sell the house in the next year, you want to pay the least amount in fees as possible, and the rate is really somewhat immaterial. The reasons why someone would refinance shortly after purchasing a home is maybe their financial situation is going to drastically improve. Maybe their credit score is going to go up, or they're going to get a big lump sum to put down, or a variety of reasons. Sometimes it's just a plain old-fashioned bet that rates are going to drop and I'm not spending any money on this mortgage today because it's not going to last very long. So just in the last month, I had 2 clients where they could have paid, call it 15,000 in points to get a rate of say 6.5, or get 10,000 towards closing costs at a rate of 7.5. And in this instance, they elected for the premium pricing, and it's a swing of $25,000 in closing costs. So they saved themselves $25,000 in fees at the expense of about $800 a month higher mortgage payment, which if they and both intend to refinance in the next year, so if they make 10 mortgage payments at $800 a month, they'll have spent $8,000 over the spread of 10 months, but they will have saved about $25,000 in fees when they took out that loan. So long story short is, if you don't think you're going to be in this mortgage for more than a year, premium pricing is absolutely the way to go if you think you're not going to be in the loan for more than a year.